Every single day, over $7 trillion changes hands in one market. Not stocks, not crypto, Forex. The foreign exchange market is the largest, most liquid financial market on the planet, and most people have never even heard of it. But here's the thing, and this is what nobody tells you when you're starting out. Most people who try to trade Forex lose money. Not because the market is impossible to beat, but because they started trading before they understood what they were actually trading. In this video, I'm going to change that for you. By the end, you'll understand exactly how the Forex market works, what currency pairs are, how leverage and pips work, and what you need to do before you ever place a single trade. Let's get into it. So what is Forex exactly? Forex stands for foreign exchange, and at its core, it's incredibly simple. It's the global marketplace where currencies are bought and sold. You've actually already participated in the Forex market, even if you didn't know it. Ever gone on holiday and exchanged your dollars for euros? That's Forex. You were literally buying euros and selling dollars. Now imagine that happening not just at an airport, but between banks, governments, hedge funds, corporations, and millions of individual traders, all at the same time, 24 hours a day, 5 days a week. That's the Forex market. To put its size into perspective, the entire U.S. stock market trades around $500 billion a day. The Forex market trades $7 trillion. It's not even close. And because it's so massive, it's incredibly hard for any one person, company, or even government to manipulate. That's actually one of the things traders love about it. The market is open from Sunday evening to Friday night, following the sun around the globe through 4 major trading sessions: Sydney, Tokyo, London, and New York. The most active time is when London and New York overlap, which is roughly 8 a.m. to noon Eastern Time. Now let's talk about how you actually trade in Forex. You don't buy a single currency, you trade currency pairs. Every Forex trade involves 2 currencies at once. The first is called the base currency, and the second is called the quote currency. So when you see EUR/USD, that's euros versus US dollars, it means how many US dollars does 1 euro buy? If EUR/USD is trading at 1.08, it means 1 euro buys $1.08. If you think the euro is going to get stronger, you buy the pair. If you think it's going to weaken, you sell it. That's literally all trading is, predicting which direction a pair is going to move. Now, currency pairs are broken into 3 categories. Major pairs involve the US dollar on one side, things like EUR/USD, GBP/USD, and USD/JPY. These are the most traded and have the tightest spreads, meaning it costs you less to trade them. Minor pairs, also called cross pairs, don't involve the dollar. EUR/GBP or AUD/JPY are examples. They're still popular, just a little less liquid. And then there are exotic pairs, a major currency paired with a currency from an emerging market, like USD/TRY, that's US dollar versus Turkish lira. These can move a lot, but they're volatile and spreads are much wider. As a beginner, stick to majors. Okay, now the part that confuses almost every beginner: pips, lots, and leverage. Don't worry, I'm going to make this as clear as possible. A pip is the smallest standard price movement in a currency pair. For most pairs, that's the 4th decimal place. So if EUR/USD moves from 1.0800 to 1.0801, that's 1 pip. It sounds tiny, but those pips add up fast when you're trading real size. Now, a lot is the unit you use to measure trade size. A standard lot is 100,000 units of the base currency. That sounds huge, and it is, but most retail brokers let you trade mini lots. That's 10,000 units, or even micro lots at 1,000 units. This is how beginners can participate without needing massive capital. And then there's leverage. This is the one that excites beginners and destroys accounts when misunderstood. Leverage lets you control a large position with a small amount of capital. If your broker offers 50-to-1 leverage, you can control $50,000 worth of currency with just $1,000 in your account. That's your margin. Sounds amazing, right? Here's the other side. If the trade moves against you, your losses are also magnified. A 1% move against a 50-to-1 leverage position wipes out your entire margin. This is why risk management, which we'll cover in a dedicated video, is the most important skill in trading. Full stop. So why do most beginners lose money? I want to be honest with you here, because most channels skip this part. Number one, they use too much leverage too soon. They turn Forex into a casino, hoping one big trade will change their life. It doesn't work that way. Number two, they have no strategy. They buy when it feels like it's going up and sell when it feels like it's going down. Feelings are not a trading edge. Number three, they skip the demo account. They put real money in before they've even proven they can be consistently profitable on paper. Every serious trader spends real time on a demo account first. And number four, they have no risk management. They let losing trades run and cut winning trades too early. That's a guaranteed way to blow an account over time. The good news? All four of these are completely learnable. And that's exactly what this channel is here to help you with. So before you ever put real money on the line, here's what I want you to do. First, open a free demo account. Most reputable brokers offer them. MetaTrader 4 and MetaTrader 5 are the industry standard platforms and both are free. Get comfortable with how orders work, how charts move, how leverage actually feels. Second, learn to read a chart. Sounds basic, but so many people skip this. In the next video on this channel, I'll walk you through everything you need to know about candlestick charts from scratch. Third, study one strategy deeply, not 20. 1. Master it on demo before you risk a single dollar. And fourth, never trade money you can't afford to lose. This sounds like a disclaimer, but I genuinely mean it. Trading with scared money leads to emotional decisions. Emotional decisions lead to blown accounts. And that's it. You now understand the Forex market better than most people who've been trying to trade it for months. In the next video, we're going to go deep on candlestick charts, the language of the market, how to read them, what they're telling you, and the 5 patterns every trader needs to know. It's genuinely one of the most useful things you'll ever learn if you're serious about this. If this video helped you, hit subscribe. It genuinely helps the channel grow and means you won't miss any of the upcoming content. And drop a comment below. What's the one thing about Forex you've always wanted to understand? I read every single one. I'll see you in the next one.